Welcome to the continuing series, Conversations in Risk Management and Corporate Governance. My name is Don Schwartz, and I'm the Director of the Center for Risk Management and Corporate Governance here at Loyola University, Chicago. Today, I'm pleased to welcome David Koenig. David is the Chief Executive Officer of the Governance Fund. He has spent a career in risk management and corporate governance and is a past chair and senior executive officer with Premia. David, delighted to have you here today.
Thank you for the invitation.
I'd like to start with this question. You have spent your career in risk management and corporate governance, either in financial risk or in enterprise-wide risk management. Recently, you have been more focused on corporate governance. What do you see as the intersection between corporate governance and risk management? Could you give us some examples? And in terms of your own thinking, how's that changed?
Sure. No, it's an interesting intersection that's taking place now. I think risk management and governance have both been increasingly part of the dialogue at corporations, part of the dialogue through the regulatory regimes, part of the focus of investors, gaining attention, particularly from the financial crises that we've had over the past couple of years. When I think about risk management, when I think about governance, and when I think about why any organization exists, it's for the creation of some value. So value is something we define particularly at the top of an organization, maybe where a board of directors sits. But value can be financial value, it can be value in serving a mission, particularly for a nonprofit entity. But ultimately, every organization is trying to create value and get the most out of the risk that they're able to take. So if I could define risk in a way that's a little bit different than most people do, it might help explain where I see these two intersecting. Risk is something that we don't know about. It's something that changes the value of our organization in some unknown amount in the future. Risk managers tend to think of the world in a stochastic way. We think of future outcomes, future possibilities. We try to assign some probabilities to those outcomes. In the same way in which people are trying to determine what today's value of something is, an organization or a company or a bond for that matter, part of what they have to understand is what the future potential outcomes are. But risk is both positive and negative. You can see an increase in value or a decrease in value. A risk event is what drives that change. So something happens, usually external to the corporation, but sometimes internal to the corporation, that drives a change in that value in some time period forward from where we are today. Risk management is about shaping the way in which that risk event impacts the value of the corporation. So through risk management, we understand a little bit more about how our corporations work, how these external changes affect the value, and we might make changes in how the company is structured. We might transfer some of our risks to give a more desirable profile. Governance, on the other hand, is the framework within which the corporation pursues its objectives of creating value. The intersection tends to be where risk managers are looking at what can impact the corporation's ability to achieve the objectives that the board has set forward. That intersection today tends to take place at the level of the executives. The chief executive officer is often considered to be the top risk officer of a company, or there's a newly emerging chief risk officer's position. In the C-level, part of the executive team, this person is responsible for helping the corporation understand its risks. Now, for a while, the chief risk officer emerged to create controls, to try and eliminate surprise losses, to make CEOs and board members sleep better. But what's changed in terms of that intersection is now risk officers are being viewed as an integral part of the corporation's ability to generate value. So it's much more of a positive interaction. There's still plenty of places where chief risk officers try to prevent loss.
Can I interrupt you for just a minute? Really, you're viewing the risk officer as an enabler.
Correct.
Isn't that really a contradiction between controlling risk and enabling?
Yeah, if the premise is that risk management is about control, it will seem that way. But control is an element to enabling the taking of risk. So businesses exist to take risk. They exist to try and create this value, but in order to do that, they have to be operating under the assumption that they have some sort of an information advantage, some sort of idea that others don't have. And by taking the step forward of using someone's capital, whether it's the entrepreneurs who starts the company or capital that they raise in the public markets, they have to take a risk. Risk managers can help them take risk more confidently, take risk better, and understand which risks they really want to keep. So they are enablers. In their best role, a chief risk officer is enabling the company to make the best use of the risk it's able to take. So control is an element to that, but if it's the leading element and the leading reason why you have risk management, you've greatly underserved the capacity of risk management to create value.
Effectively, thank you for that introduction, because we're really talking about valuation, aren't we? And we're talking about what is the price of risk. Let's put it in the context of today. First of all, do you think that we are properly pricing risk today? And secondly, is it possible for corporations to proactively manage investors' perceptions of risk, thereby creating value?
Yeah, I think the last part, which you asked about perception, is probably one of the most important questions to be asking, because the influence on value, particularly for publicly traded companies, is greatly driven by what people perceive about a company. To get to the question about whether the market is accurately pricing risk today, what I would say is we never know that until we have hindsight. So the price of risk today is based on some expectation. In finance, we often look to things like markets to determine whether risk is priced fairly. And in option pricing, we have something called implied volatility. We have fairly standard option pricing models that look at where the price of risk is trading today on a company, whether it's a call option or a put option. Out of that model comes this metric called implied volatility, which is some statement about the perceived future risk or future distribution of values of whatever that option is based on. Again, whether it's a company, a bond, whatever it might be. Implied volatility, theoretically, we would think, is a good predictor of future risk. In practice, implied volatility is a terrible predictor of future risk. It's a wonderful reflection of events that have just happened.
A sentiment measure.
It's a sentiment measure backward looking. And one of the things that I think has been revealed through behavioral finance and some of the studies in psychology is looking at how people process risk and process their understanding of risk. Elke Weber, who's a professor at Columbia University, mostly is doing her work in the field of psychology, but I think people in finance would do well to pay a great deal of attention to the work that she's doing, because it has a tremendous amount of applicability to what we're doing in finance. One of the areas in which she's worked is how people process risk. And so what she has discovered is there are two functions and two ways in which people tend to process risk. The first is an automatic response, which dates back to when we were surviving, based on whether we responded quickly or not to something that had happened around us. We might be eaten if we don't respond properly. That's deeply ingrained in us. It tends to be automatic. It tends to be one that doesn't involve a lot of thinking, but it does generate actions on our part. So in the case of implied volatility, for example, in the options market, when we see a large decline, particularly in the price of an equity or the price of a bond, we tend to see the implied volatility on option prices go up immediately. That's a reaction to the perceived risk that has just happened.
It's an ex post.
It's an ex post response to something that just occurred. But the analytic process, which takes time and allows us to process every other input that we have, is one that eventually returns volatility and other measures to the point at which they naturally would be. It's much more of a long-term thought process that creates a better sense of what the risk is that something presents to you, an investment, for example. So the question was about whether perceptions impact value. Any financial instrument, any company, anything that has a return of cash flows to investors can be valued through simple discounting of those cash flows. When you own an equity, when you own a mortgage bond, for example, what you don't know is how much those cash flows are going to be when they're returned to you, how long you're going to get those cash flows. And so in valuing companies today, we want to know whether there's a likelihood that that stream of cash flows will be interrupted. We want to know whether those cash flows are going to be used for investment well within a company. And then ultimately, we have to discount those back based on what our perception is of risk. In governance, in the influence of governance and values of companies, that well-governed companies tend to generate cash flows over longer periods of time. They tend to be less likely to have a major interruption in their cash flows.
So essentially, what you're valuing is the certainty of a cash flow and the duration of a cash flow.
That's the first thing. That's the first element of it. Governance then ultimately has its biggest impact on the value of companies on the perception component. So we discount cash flows by a risk-free interest rate, which is what we can get if we want to in the old days when Treasury bills were risk-free, invest in Treasury bills, plus some sort of premium for the perceived risk that we're taking. In behavioral finance, there is something called loss avoidance, a behavior of loss avoidance that shows people tend to value or fear large losses, multiples of the positive association they have with large gains. So when a company presents to an investor the possibility of large losses, the discount factor that's applied to those future cash flows, those unknown cash flows, is substantially larger than if investors perceive it to have very low risk to large losses. Well-governed companies tend to be resilient. They tend to build this ductility into their nature and the way in which the organization is run.
Can I stop you for just a second? You used the word ductility. And for our viewer, would you explain what that means?
Sure. Ductility is the ability to bend without breaking. It's a principle of matter of, you want a bridge, for example, that you drive across to be ductile. You want it to be strong, but you also want it to be ductile so that it can change its shape but resume that shape after the stress of driving over that bridge has passed. So in corporations, you have risk events that are happening. As I mentioned, risk events drive changes in value. We don't know what the ultimate impact of those changes in value is, but we try to use risk management to determine what those would be. A ductile corporation responds to unexpected changes, particularly from external influences, and changes its shape, whether that's a change in customer preferences, whether it's a change in the cost of borrowing, whether it's a change in liquidity that's provided to the company, whether it's a change in the economic conditions of the economy as a whole, whether it be national or global. Resilient and ductile corporations understand how to move capital around, change the human resources that they have in place in order to meet those changes. And that's part of being well governed. So when you have a company that's perceived as being that way, it's perceived as presenting low risk of high loss to an investor, and there's a tremendous influence then on the value, a tremendous positive influence on the value of that corporation as that realization occurs.
Well, let me take that idea of valuing and pricing risk and start to look a little bit about the structure of governance. You've done some thinking on this. Do you have some suggestions or recommendations for the appropriate governance structures for a company? And what are some of the things that motivate your recommendation?
Yeah, that's a good question. The typical governance structure that we see today is very hierarchical. It's what most of us are comfortable with. It's a top-down order. So you have a board of directors who is setting policies for the corporation, a CEO who is going after the objectives that the board has set or sometimes that the board has approved, which are the CEO's objectives. The CEO is handing that off to the management staff, the senior management team. The senior management team hands it off to the next level of management, on, down to the point where people who are selling the products, in the case of a bank, they might be trading, whatever the case may be. It's a long way from the board of directors down to the points where risk is being originated. That's the very typical structure that we find today. The hierarchical structure of governance suffers from a number of problems, and I'm not just saying this because we've seen a number of companies who've had problems recently, but if you think about the nature of what is trying to be done in a hierarchical structure, it's the equivalent of somebody trying to plan an economy, be a very small economy. Let's take, for example, someone who's trying to organize everything that's happening even in a small town's economy, whether it's the baker who's selling bread but buying flour from the local distributor and getting the people into the store to buy those things. That's just one element. Trying to be controlled from the top down. What the board says in terms of its objectives is communicated well often to the CEO. But after that point, there's a great deal of loss of information that takes place at each level that communication occurs.
Let me stop you here. Is it fair to view this governance structure at the top, face-to-face, then like a spinal cord, and with each vertebrae becoming a problem for communicating the message going down the vertebrae?
Yeah, no, I think that's true. There was some estimates that between 10 and 20% of the value of a message is lost at each point at which it's communicated. It's the old game of whispers where at the end of a long table, somebody starts a story and you check to see what the story is by the time it reaches the last person in line. And the story usually has some fundamental elements that are different from what the original story was. That's the case with both objectives that are being set by the corporation as well as the rules within which those objectives can be pursued. So I think the fundamental problem with a hierarchical structure is that it's a communication problem from the top down. The second...
But it comes from management at the top to operations and execution on the bottom.
Who I would call the originators of risk. That's correct. That's where risk is being originated, is at the point that you face the customer, at the point you face the regulator, the point you create product or deliver product to your ultimate customer. Another point of communication that's a problem within the hierarchical structure is that the board of directors doesn't have a way to gather independent information. I think you and I both know a gentleman named Shan Turnbull. Shan Turnbull's been an advocate for something called network governance, and I think network governance has a lot of very positive elements to it which try to address some of these communication problems. In Shan's version of network governance, and I'll give a very short summary of it here because I think it's fairly complex and something that takes some time to digest, but one of the elements of Shan's model is that there's an external committee, a stakeholders committee, for example, that gives the board of directors independent information. These stakeholders might be suppliers, they might be creditors, they might be employees, retirees, all people who have an interest in the longevity of the corporation and the performance of the corporation that's different from what the CEO has. So a board of directors, when they hand off this responsibility to the CEO, creates agency risk. And agency risk, as you know and most people watching this probably know, is that when you ask someone to do something on your behalf, they may act in their own self-interest, probably will act in their own self-interest, and may not do everything that you want them to do. This form of network governance that Shan talks about puts a check on that agency risk because the board of directors is able to get an independent source of information as to whether the company is living the ideals and pursuing the objectives and achieving the objectives that it's set that's independent of what the chief executive officer is representing.
Let's see if I can inject a thought here. Two ways. Is it possible that we could create a parallel reporting structure for risk separate from the chief risk officer and have that report to the board? And secondly, this idea of multiple stakeholders in governance, is that really operable, particularly given competing objectives?
The last question is an interesting one, and I don't know that it's necessarily due to competing objectives. I think it is due to what is very much entrenched. So if you go to a board of directors today and say, we'd like to create this committee that's going to provide you with an additional set of information, it's not comfortable to them because it's not what they're used to. Now, Shan's recommendations go a little bit further than what I had just suggested in that he actually thinks these stakeholder committees should have some veto rights over what the board of directors does. So it makes it even less likely.
Your customers and your suppliers have veto rights? That's an interesting...
Yes, it is an interesting concept, but it's something that makes it resistant for boards to change. But you ask about this parallel structure. Today's risk manager and chief risk officer and risk infrastructure tends to be put in the corporation today in some ways like a parallel infrastructure to what the business is doing. This tends to be where the control model has the strongest influence. I don't think that's the best use of the risk function within the company. As I'd mentioned, I think risk officers and risk managers within the corporation are best served at helping people take risk better. So this gets to another model of governance, which is called distributive governance. Distributive governance tries to push the management of risk as close to the point at which it's being originated as is practical or possible. In this case, for example, somebody who's originating a loan at a bank has special knowledge about a customer that isn't possible for the head of credit risk to know. But the head of credit risk can help to educate the people who work very closely with the loan originators to help them identify what issues should be escalated, what problems might be signaling something bigger in terms of a credit risk, and dealing with them, giving them the authority to deal with those issues quickly at the level at which the risk is being originated. So this network governance combined with this distributive governance, I think, provides a very effective model for corporate governance. There's another model called the Carver model. And the Carver model for governance is this nested policy model, which is very similar to what I'm talking about in terms of the distributive model. The Carver model is that the board of directors has the objective of setting the objectives, setting the rules for pursuing objectives, hiring and evaluating the CEO. That's it. That's all they do. The CEO then nests, and that's what their policies are. The CEO then does the same kind of transfer of authority at successive levels within the organization, each time creating a new set of policies. So the policies that are created in the lower levels of the organization have to be subsets of the bigger policies. That's the nesting concept. And I think it's a very strong way of looking at things. Now, you create a substantial amount of agency risk in this model. I mean, I think it's higher than even in the hierarchical model right now, a substantial amount of agency risk. So this parallel structure, or even just some check and balance from outside of the corporation, I think, has merit. Today, a number of chief risk officers have a direct or indirect reporting line to the board of directors. That creates a conflict for the chief risk officer because they may be viewed internally by the company as someone who they can't completely trust. If that's the case, they won't be invited into discussions about how to best take risk and how to manage emerging risks. On the other hand, the board might not completely trust them because they know that they're being compensated by or driven by the success of the company. So if we create somebody on the outside of the corporation who is a direct report to the board, but who has risk management expertise, that person can come in and effectively audit the risk management operation to see if what's being represented by the chief risk officer or maybe the chief executive officer to the board is an accurate reflection of how the risk culture and how the risk management structure is working within the company. That, I think, gets to be very powerful. So it brings in some of the network governance. We've got this external stakeholder or somebody who's been engaged by the board to have a role that's a control role, a validation role. In addition, then, you can emphasize how the chief risk officer within the company is supposed to help the company take risk better and more confidently, as opposed to viewing their chief role being the elevation of major events or potential risks to the board.
Let's come in. Thank you very much for a very interesting explanation. Let's come down to the last 2 years. We've seen a number of spectacular collapses, a number of which occurred in spite of published strong financials, and they occurred sometimes to the great surprise of the board. Why did these collapses happen so quickly? Why did the boards get it so wrong? And could you inject your concept of a tipping point?
Yeah, I don't know in each case whether it's fair to say that the boards got it so wrong. I'm sure there are cases that they did. I don't know specifics in a number of cases to say why it happened. But we know at companies like Bear Stearns and Lehman that their businesses disappeared more quickly than anyone would have ever expected. And you looked at the way in which creditors viewed them, the way in which equity investors viewed their companies. It was certainly faster than any of those thought was possible.
Did they vanish so quickly for financial reasons, or were there other driving factors?
It seems that it's mostly a loss of customer faith and a loss of faith from the stakeholders like liquidity providers, creditors, and regulators. So these are all people who have a very strong influence on the company. Risk managers, and trying to get to the question about how this happened and the tipping point concept, risk managers have become very good at dealing with small changes, small risk events, small changes in the value of things. So again, bonds, stocks, or things that affect the value of the corporation. We're very good at those because that's where most of the activity in the marketplace happens, small changes from today's value. We thought that, and risk managers typically started to think that they were very good at assessing the probability and impact of very small likelihood events. So these are called tail risks. And we found often that risk managers were saying with 99.75% probability, this is the expected loss that we have of the company and this is how we should be capitalized. I've never been of the belief that anything to the right of the decimal point is reasonable. And I'm sometimes curious about the first point to the left of the decimal, whether we're very good at even projecting that. But nevertheless, we went forward with that. That was ingrained in a number of our regulations. It was how capital was being allocated. But what we didn't pay attention to, and I don't think we still do, is what happens between when we move from the middle of the distribution, these very small changes, out to the tail event. Somewhere in between there can be a change in how regulators perceive us. And they could come in and intervene, for example, and close down a bank or shut down a company or assume control of the company. It may be that our creditors and liquidity providers change their sentiment about us. and it may be that our customers change their
Sort of like a
sentiment about us.
self-feeding momentum
It's a
from all these
self-feeding momentum. Yep. There is within, again, in the behavioral psychology world, something called the social amplification of risk framework. The social amplification of risk framework primarily has looked at the impact of physical risk events, so earthquakes, volcanoes, things like that, flus and the like, to understand why it is that some risk events have a larger impact than their initial impact and some don't. Why is it that some amplify? And what they find is that the communication channels, the points at which there's social interaction between people, are what contribute greatly to the amplification of a particular risk factor. And people tend to communicate about things that they either don't understand or that they fear in terms of the degree to which there will be an impact. They call this dread and lack of knowledge. When you have a high correlation of dread, or I should say a correlation between a high level of dread and a high level of, or high lack of understanding, for example, you create the potential for amplification to happen. So in the case of the subprime crisis, which was really what drove Bear Stearns and Lehman out of business, you had a point at which people saw things happening around the world that they didn't understand. They had a great deal of fear that the impact of these would be large and might threaten themselves. So when they had both the combination of a lack of understanding of the exposures that these companies had, as well as the fear that the impact might be on them and as well on the economy or the financial system as a whole, they acted very quickly, again, processing risk in this automatic response way, the way in which I described, that Professor Weber has described, and pulled their credits, or they pulled their accounts, or they pulled their liquidity lines. And when that happens, there's no coming back from that. That can happen well before you've run out of capital. So the assessment that these companies might have had was that they were a single A credit or a double A credit based on the credit models that we have for probability of loss in excess of our capital. It may turn out that there are substantially lower credits than we thought because they were subject to an amplification risk that no one understood. And this is something I think that boards have to take account of. They not only have to look at what the low probability, high impact losses are that they think can knock the company out of business, but to take that one step further and to say which risks could be amplified and take us out of business sooner. I think it's the amplification that was the case in these two.
Actually, you've led into what I like to think is the concluding question here. You have a panorama of risks, and you have human beings trying to manage. Is it reasonable or realistic that boards and management can manage an ever-changing panorama of risk?
Tough question. Is it fair to hold them accountable? Certainly they have to be held accountable for the way in which they make business decisions. We have the duty of loyalty and the duty of care. So this falls into the duty of care that any director has. The obligation for care, though, I think means, do I understand how my company is pursuing the objectives that we've set forward? Not necessarily do I understand all of the risks. So I think there's been more of a movement today to try and hold board members accountable for risk management.
So what you're really here focusing isn't on the risk, but it's on the behavior.
Well, getting back to what I said about governance, governance is the construct. It's the framework within which a business operates. It's not the running of the business, it's the framework. So a board needs to be fully aware of the framework that they've established. That includes whether you've got these network interactions, whether you have checks and balances on the agency risk that they have. They have to have an understanding about whether compensation policy is such that it's not incenting behaviors that they don't want. Those are the kinds of things they need to understand. But I think they also have to know whether they have put sufficient information systems in place so that the corporation, where the risks are being, or the management, where risk is being originated, understands the risks that it's taking. So the board's question isn't, do I understand the probability of loss on these particular credits that we've extended, or do I understand our supply chain risk to this particular company who's a key supplier of ours? But they have to say, do we have the capacity within the corporation to understand those at a management level and an implementation level?
So effectively, what you're talking about here are recommendations, whether they be incentive compensation or supply chain or customer relationships. The question I have of you, in today's environment, what are some specific recommendations that you would have for a corporate board in terms of things that they can and should be doing. And also not only tie that into risk management or risk mitigation, but how would you advise corporate boards to work with management to sort of optimize the profile of the company? I know that's a pretty opening question.
Yeah, but it's quite a bit. I'm not sure I'm up to that.
That's why we have you here.
I think that boards are good at discussing objectives, and that's something that they lay out well. What I don't know that there's enough discussion of is what the drivers are of success for those objectives and what the threats are to the success of those objectives. It's when you get into understanding those drivers and threats that you can ask yourself whether you have the infrastructure in place to address those and understand them well from a managerial standpoint. So boards first have to ask the question, do we understand what drives and what threatens the objectives we've set forth? Second, do we have an infrastructure in place, which may be a separate risk management infrastructure, to accurately quantify or qualify, put it in a non-quantitative expression of what drives what we're doing. Are we able to manage these things? That's first. Second, I think they need to be able to stay out of the management side of the business. I think there's some boards that try to get into managing. I know of cases in some companies that have recently collapsed where board members were in directing lower level employees and how to do their work. That's not a board's role. No, that's not the role. It's tempting, I think, for some people, particularly if they have technical expertise. But they have to stay elevated at the policy level and trust that the agency risk they've taken with their CEO is acceptable. So they have to manage that agency risk through creating this network governance structure where they get external inputs from key stakeholders. I think they should create an external validation of the risk framework that they have in place, whether it's a financial risk framework or an operational risk framework. And I think they need to do everything they can to push out the management of risks to the point at which risk is being originated. There's great work being done in the area of complexity and complexity economics, and they talk about the way in which systems naturally work. Systems don't tend to naturally work by the queen in the beehive or the queen in the ant farm giving directions out to all of the workers. They find ways to work together to create the ultimate objective that they have, which is survival and growth of the colony. And that's what businesses can do as well. So if our boards are looking to see whether there's too much hierarchical control in the organization, that's another thing that they can be doing. So those are some of the specifics that I would put in place.
Well, I'm certainly glad you ended on the concept of complexity because you've done a marvelous job of summarizing it, and I want to thank you for being with us and love to have you come back and talk to us again.
Thank you. I appreciate it, Don. Always a pleasure.